So welcome to chapter 7, which is on incremental analysis. There are 6 different learning objectives in this chapter, but all of them are relatively brief, as you'll see. So first, we're going to start off looking at the management decision-making process that management goes through using, um, and we'll be using incremental analysis in that decision-making. Okay. So you all kind of know about this because you've all taken your earlier business courses and understand management. The decision-making role is a very important role, right? And most of the time, the process is listed where you identify a problem, you determine and evaluate your choices, right? There's many different ways in which you could answer that particular problem. And then, of course, you need to go ahead and make the decision which choice is the very best one for that situation. And then, you review the results to see if that decision was indeed the best one. Right. So, when making a business decision, it's important that financial information is often emphasized as the most important part of the decision. But I can tell you that the non financial piece is equally important. Okay. So for financially, of course, you do have to look at revenues and costs and profitability. There's no doubt about that is important stuff. But it needs to be balanced in essence with the effects on employees and the turnover rate, which is how quickly they're quitting and you need to replace them is really what turnover is. The environment, the overall company image that you have, and how you want to keep it. All very, very important. Okay. So we use something called incremental analysis to help us choose among different possible actions. Okay. It used to be called differential analysis because, in essence, the analysis here focuses on the differences between choice A, choice B, choice C, etc. Whatever the choices are, what are the differences in the outcomes? So that's important. The financial data we're going to be using here involve both costs and revenues. And so in some cases, only revenue is going to change. In some cases, maybe only cost will change. But in many instances, both will change. And so it's important to sort of all know how to do that. So here is a basic approach to incremental analysis showing 2 alternatives and the differences between the two. So in alternative A, we would have revenues of 125,000, costs of 100,000, and a profit of 25,000. In alternative B, we would have revenues of 110,000, costs of 80,000, and a profit of 30,000. What would be the differences, right? Well, we look at the differences from a profitability perspective. Okay. When we have this alternative A, 125,000 in revenue versus alternative B, 110,000 in revenue, that would mean a decrease in revenue of 15,000 also decreases the profit. Because remember, revenues are directly related to the profits, right? Matter of fact, profit is leftover revenue. Right? Revenue minus expenses gives you your profit. So the profit really comes from what's left over on your revenue. So if we had lower revenues, in essence, we would look at that as a decrease in the profitability of that option. However, for costs here, alternative A has 100,000 of costs, alternative B has 80,000 of costs. Those lower costs would add to the profitability of the company. So notice this $20,000 here looks like an increase because in essence, anytime we would decrease expenses, it would increase your profits. That's how this is looked at. Okay. So what would be the difference? The difference would be a $5,000 difference between alternative A and alternative B in alternative B's favor, right? So again, incremental revenue would be less, but the incremental cost savings would be more, meaning the profit could be more. Thus, alternative B produces more profit. Okay, so alternative B would be a very, very good choice of the two because of incremental analysis and how we look at it. Okay, so you'll be doing this. So a couple of concepts that are really important to understand, and I didn't mean to toss out the concept there, I meant to underline it, but I really can't do lines. So here we are with relevant costs, opportunity costs, and sunk costs. And these are very, very important issues to look at when we talk about incremental analysis. And I'm hoping that there's a next. All right, so this side, basically what we have here is, again, we look at both variable and fixed costs. Sometimes fixed costs don't change, variable costs don't change. Sometimes fixed cost changes, other times it might not. So when we look at the whole thing here, and this is actually not showing you what I wanted to show you. But relevant costs, in essence, really this is really the only factor that we look at regarding incremental analysis. This is the most important thing. Because these are the things that are going to be changing. And so these factors are quite relevant. Okay. The opportunity cost is what we're going to be giving up by choosing alternative A versus alternative B, right? So those are going to be the opportunity costs in looking at incremental analysis. What are we giving up if we choose A versus B? Are we giving up more revenue? Are we giving up, something? And then the last type of thing we look at here is something called a sunk costs. Sunk cost doesn't change regardless of the issue. For example, and your book has a great example here. If you're thinking about repairing or replacing your laptop computer, right now, the one you're using right now, you wouldn't be considering the fact that you already bought that computer, right? Because you've already owned it for a time. That's a sunk cost. It doesn't have a determination in your choice to A, repair it, or B, replace it. It is a sunk cost. You already bought it. You already own it. It's not an issue in the decision. Okay. So in that sense, that's what you're going to be learning to distinguish between all of these three. So I wanted to make sure I backtracked on those. Okay. So what types of decisions are actually using incremental analysis? Well, this particular chapter goes over these 5 specifically. Learning Objective 2 talks about, well, what if we accepted an order at a special price from a customer? Learning Objective 3 talks about whether we should actually make the components or buy them. Make or buy type of decisions. Learning Objective 4 asks, is going to show us whether we should sell the product as is or process it further. Is it worth our time to process the product yet even further? Learning Objective 5 talks about whether it's time, how do we decide to repair, retain, or replace equipment? And Learning Objective 6 here, which is the 5th decision listed here, is how does a business decide to eliminate an unprofitable part of their business or an unprofitable product? So all of these are individual learning objectives within this chapter, okay, that we're going to be reviewing. Okay. So Here's a little company insight from American Express. No doubt every one of you have received an invitation for a credit card company to open a new account, for sure. But how many of you have received an offer of $300 to close your account? Not that many, right? So American Express decided to offer some of its customers $300 if they would give back their credit card. Okay. um, this was all, why would they make a decision to do something like this? Okay. As long as you agreed to give up your credit card, they would give you the $300. Well, they had to decide based on their goal here, that they wanted to purge. So, certain types of customers perhaps that were costing them money to service that wasn't worth it. And thus they made a decision to, that it's worth really the option A, pay them $300 to close their account, or option B, leave their account open. They saw value in closing these particular accounts, and they used incremental analysis to do it. So you'll learn more about those types of things, as strange as they might seem. So here's your do it exercise for the very first part of this chapter. Corporation O&T here. They have two different options at stake. The company currently uses option one. Option one has revenues of 80,000, maintenance expenses of 5 per year, operating expenses of 38 per year. Option two, however, would provide revenue of 80,000, maintenance of 12 per year, operating expenses of 32 per year. Option one employs a piece of equipment that was upgraded 2 years ago at a cost of 22,000. If option two is chosen, it would free up the resources that will increase revenue by 3,000. So what we're going to be learning about is how to do one of those tables that we should. So what's the difference between option one and option two? And make sure we understand that there will be a sunk cost in all of this. So let's take a look at what we're thinking here. So first things first, the company currently follows option one, which is revenue of $80,000. Option two is also revenue of $80,000. So no change in the revenue in both options. Maintenance expenses for option one are $5,000 a year. Maintenance expenses as option two is $12,000 per year. So in essence, option two with higher maintenance expenses would decrease their net income, decrease their profit by $7,000, because more costs mean less profit. Operating expenses went from 38 to 32, which means that because option one expenses are higher than option two expenses, option two would, in essence, increase their net income by 6,000, because the lower the expenses, the bigger the profit. Now, this is the interesting part on the upgrade of the equipment, right? Because again, they employ a piece of equipment that was upgraded 2 years ago. 2 years ago should be the hint. This has really nothing to do with the decision today. They already spent the money to upgrade it 2 years ago. So that's going to be the sunk cost here, because this happened long ago. It has actually nothing to do with the decision they have to make today to whether we continue with option one or do option two. Okay, that's a sunk cost. However, if option two is chosen, it will free up resources that will increase revenue by 3,000. Okay. So in essence, with option 2, right, they would be able to actually increase revenue or their profit by 3,000. Okay. Because option 1 is actually absorbing that. So the difference here would be a net income would actually increase by $2,000, which means option 2 looks like the very best option to go with. So that's learning objective 1 and sort of an introduction to incremental analysis there. So I'm going to pause everything and see if we're okay. Okay, and we're back with learning objective 2. So here is how to use incremental analysis to help them make a decision whether they accept an order at a special price. Okay, so they're already making certain things for customers. What if sometimes a customer says, look, if you make a little bit more for me, I'll give you this price for it, should they actually take it or not? So again, the additional business would be nice, right? You have to assume that your sales of all your other products are not affected by this order. And you also have to assume that your factory is not at full capacity. You actually have the capacity to make extra stuff. Right? So what if you do? Well, let's take a look. Okay. Here we have a company called Sunbelt. They produce 100,000 smoothie blenders. Matter of fact, I think that's how they say it. It's actually, it should be like extra O's in there. Smoothie blenders. Okay. Which is at 80% of their capacity. So the factory is already working at 80%, but they clearly have some capacity to make more. Still 80% is high, but clearly they have some room. Variable costs $8 per smoothie blender. Fixed manufacturing costs are $400,000 or $4 per smoothie blender. The blenders are normally sold directly to retailers for $20 a piece. Mm-hmm. So Sunbelt has this offer from Kensington Company, which is a wholesaler, to purchase an additional 2,000 smoothie blenders, but at $11 a unit. Just these extra 2,000 would be at $11 per unit. Well, should they accept? Should they accept? Again, you need to know it would not affect the normal sale of the product. This is all additional units. So what should they do? Well, let's figure it out. If they rejected the order, meaning they didn't do it, they would have no revenue, no new revenue. If they accepted the order, they would accept it at $11 per smoothie blender and 2,000 blenders. So $22,000 if they accepted the order. So that means that their profit could increase $22,000 just with revenue alone. Well, the costs matter a lot as well. Of course, if they rejected the order, there's no cost involved. But if they accepted the order, right, each smoothie blender would be needing to absorb, I'll have to go back to show, I think it's $8 per unit in variable costs and $4 per unit in fixed costs, right? Times 2,000, that's your 16,000. So that means that 16,000 in costs would also take away from profits. The net income, if they rejected, would be 0. If they accepted, would be 6,000. So accepting the order would mean a $6,000 increase to net income. Okay. So this is important. This is important to know. Here it mentions that the fixed cost issue, which they say they listed at $400,000 for the month or $4 per unit. In this case, the fixed costs wouldn't be relevant because they would have to pay the $400,000 for the month anyway. So the only thing that becomes relevant is the $8 variable costs per blender, because that would change. The variable cost total would change. The fixed cost total would not. So I think it's confusing when they say $4 per unit for fixed, but the $400,000 is fixed per month. So in this case, the $16,000 here is the 2,000 blenders times the $8 variable cost. And I'm sorry not to have brought that up sooner. But in this case, the total costs don't change if they make a little bit more. But the blenders would add to the variable costs. That would change. So for your do it exercise example here, we have Cobb Company. And Cobb Company incurs costs of $28 per unit, 18 of that is variable, $10 is fixed, to make a product that it sells for 42 bucks. A foreign wholesaler offers to buy an additional 5,000 units at 25 bucks each. Okay. What will Cobb incur? They'll incur an additional shipping cost of $1 per unit. So what is the increase or decrease in net income that Cobb will realize by accepting it rather than rejecting it? And we're assuming that Cobb does have additional capacity to make these additional 5,000 units, and it won't affect anything else. So, of course, if they reject everything, it's zero. No revenues, no additional costs, no additional profit. However, if they accept the offer, 5,000 units at $25 a piece would give them 125,000 in more revenue. Okay. Now their costs, in this case, the only thing that's going to be affected is their variable costs and the fact that they have to pay an extra $1 for shipping. So the variable costs are 5,000 times 18. The shipping is 5,000 times 1. That's how they get the 95,000. So if they accept the order, they would increase net income by 30,000. And that, of course, is what your difference would be. So what should they do? In this case, they'll make money. So they should definitely accept the order. Okay. I'll take a pause here as well and see if there's any questions. So learning objective 3 looks at incremental analysis regarding what we call a make or buy decision. So for a lot of companies, that's really their choice. Do they make it all themselves, or is it better to buy it from a supplier in certain things? Some of these things that we're talking about in manufacturing are quite large, right? So whether it's an automobile or an airplane, there are a lot of different parts, a lot of different things that go into it. Does that mean that Boeing as an airline company, they have to make everything? No, they're going to make some things, they're going to buy some things. Does that mean General Motors or Tesla, Toyota they're going to make everything themselves? No, they'll make some things, they'll buy some things. This is one of the ways they help decide what they're deciding to make and what they're deciding to buy from suppliers. So it jumps right into an illustration. They have this company, Barron Company. They have the following annual costs producing 25,000 ignition switches for motor scooters. I like to say that fast. Ignition switches for motor scooters. All right. So, and here is the breakdown. Direct materials, 50,000. Direct labor, 75,000. Variable manufacturing overhead, 40,000. Fixed manufacturing overhead, 60,000. Total manufacturing costs, 225. They're making 25,000 ignition switches for motor scooters. That's $9 per ignition switch for motor scooters. Question. Instead of making their own switches, Barron Company might purchase the switches at a price of $8 per unit. What should they do? Again, a lot of you are just looking at this price and saying, yeah, there's more to it. Hang in there. So right now they are making these ignition switches for motor scooters. I'm saying that quite deliberately because I'll mess up my S's and I'll throw all types of shit in there. So their annual cost is $225, as we went over. What if they decided to buy the switches? Well, they wouldn't need any direct direct materials. So that would increase their net income by 50,000. They would not need direct labor, so that would increase their income by 75,000. However, they did not have any variable manufacturing costs, so that would increase their net income by 40,000. However, not all fixed costs are eliminated. Okay, so they're going to absorb 50,000 of fixed costs anyway, right? So they're only going to save 10,000 there. And then of course they're going to buy them. They're going to buy 25,000 of them at $8. So they don't buy them now, they make them. So if they went ahead and buy them, it would be 200,000. So to actually buy them, it would actually cost them a total of 250,000, even at the lower price. That's what a lot of people make mistakes when they think about those other things that I was mentioning earlier. But they're still going to have some fixed costs regardless. They're going to have some fixed costs regardless. That doesn't go away. They might save on these other types of things, but fixed costs never go away. They might be reduced in some cases, but they don't go away. And then you still got to fork out the money to buy stuff. So they're going to be forking out $250,000 to buy it versus $225,000 to make it. So if they went ahead and buy that, they would actually be losing, right? Their net income would decrease, their profit would decrease 25,000. So what would you do? Easy to decide, right, in this case. However, I'm sorry, I didn't mean to fly through that. The opportunity cost here is, since they're not using much of what they are, because they're not making it, so they have all this excess going on. What if they could actually benefit by using that from an alternative course of action? Okay, so it's important for management to take into account, right, the social impact of the choice. So for instance, buying might be the most economically feasible thing to do, but the result could be a closure of a plant that employs many good workers. Good workers do not grow on trees. It's important to know you want to keep good workers. So let's illustrate this a little bit more. So let's assume that through buying the switches, Barron can use its excess productive capacity, right? Because they'll have all this labor sitting around. They'll have some variable costs they can use, and they're not using their entire factory, right? Because they're buying it, not making it. So let's say they can actually generate $38,000 of other income by producing a different product with that. Okay. So this lost income of 38,000 would be an opportunity cost if they chose to make it, because then they wouldn't be able, if they're making the switches instead of buying them, they wouldn't be able to use the factory to produce this other product. Thus, they'd be losing out on the opportunity to make an additional 38,000 on top of it. So then we have to add a little bit of a twist to this, right? In essence, if we were able to make, excuse me, if we were able to make the product, if we were buying the product and not making the product, we would in essence end up losing a 38,000 in opportunity cost, which means that actually making the product may be more expensive, not because of the cost of the switch, but because of the opportunity cost involved, that we can use that excess capacity to generate something different. And thus, we would be able to increase our net income by additional $13,000 if we decided to go with that. Okay. So with a make or buy decision, almost everything becomes relevant. What costs are going to be saved? What's the purchase price of what we're buying instead of making it? And what about those opportunity costs? What are we giving up by making that choice? Okay. So here's a company insight regarding Amazon, right? Everyone's favorite pandemic company, right? So, so some analysts have questioned whether some of the methods Analyze uses to increase its sales makes good business sense. For example, Prime membership. Well, at the time this was written, 2011, it was $79 for a year. It's what do I pay? I think it's $119 or maybe $129 a year starting this year. And that means that Amazon customers get free shipping on all their goods, right, throughout the year. And Jeff Bezos promised that the program would be costly in the short term, but benefit the company in the long term. 6 years later, Amazon sales had grown considerably. And it was estimated that Prime customers buy 2 to 3 times as much from the company as non-Prime customers. Its shipping costs rose from 2.8% of sales to 4% of sales, which is similar to the drop in its gross margin. Okay. However, Bezos still tries to justify it. Right. He said, okay, Prime is actually going to do many other things, like free internet movie streaming and other types of things. So perhaps some incremental analysis would have helped Bezos on this, or he might have decided to do it anyway. Never know. So just because we have these tools available to help managers make decisions doesn't mean that it's always going to change their mind. Bezos he knew it was costly. He knew maybe perhaps if he did do an incremental analysis, it wouldn't have looked good on paper. But he did still feel as though that was the right decision. So he used non-financial measures rather than the financial measure to make a choice. So here's our final example, make or buy with Juanita Company. They need to decide whether to make or buy some components for the appliances. The cost of producing 166,000 electrical cords for its appliances has 90,000 of direct labor, 20,000, sorry, 90,000 of direct materials, 20,000 of direct labor, variable overhead of 32,000, and fixed overhead of 24,000. Instead of making the electrical cords at an average cost of $1, the company has the opportunity to buy those cords at 90 cents per unit. If the company purchases the cords, all variable costs and 1/4 of fixed costs would be eliminated. And they're asking us to prepare the incremental analysis on whether they should make or buy the cords. That's the first thing they want us to do. The second thing they want us to do is say, look, would your answer be different if that extra productive capacity gave them an additional $5,000 of income? So that would be an opportunity cost to look at. So first things first, they are making the cords right now, and it's costing them a total of $166,000. What if they decided to buy the cords, right? Well, they wouldn't have any materials or labor. Variable costs would be zero, but their fixed costs would only be reduced by 25%, right? So they would still need to pay 75% of those fixed costs. Now they would actually have to be paying 90 cents for all 166, it's not supposed to be $1,000 cords that they need. So in this case, they would end up basically, if they went ahead and bought them versus continued to make them, their profit would take a hit, right? Their net income would decrease. So buying them even at that lower price is not worth it to them because their profit would decrease. Okay. So again, Juanita would incur additional costs if it buys them, so it's not a good idea. What if they were able to make an additional $5,000 where opportunity cost is involved? And so basically in this case, it would add an additional $3,600. So if they didn't do anything, right? You saw from the previous slide, they would lose $1,400. But when you actually add the additional $5,000 that they would make if they decided to buy it, that increases their total profitability by $3,600. And so their net income would actually go up if they bought the cords, knowing that there's an opportunity cost benefit for them as well. And those are the topics for today.